The Fed has held rates steady again today, but could that mean relief is on the way for mortgage borrowers? We break down what the Fed's latest decision could signal for housing and home financing. Mortgage rates have been stubbornly high, but could the Fed's latest move be the turning point? We're diving into what's next and what it means for your wallet. I'm here with Nathan Santa from our from office here at Morgan Financial. How you doing, Nathan?
Doing good. How are you?
I'm good. So we had another Fed meeting today.
Yep, big day today.
Big day today. Fed Day is always a fun day. And, today was, I'll be honest, it was a little bit uneventful, but it was what wasn't said that held the biggest impact today.
Yeah, there's a lot of speculation about what was going to be said, what was going to be done. Nothing done so far, so kind of holding steady.
Yeah, right. So we're going to talk about, the things around the Fed holding the rates and what this means for our borrowers, consumers, and real estate industry professionals out there today.
Yeah, so I think the first question is, what is the Fed? We hear a lot about it, but it's like, who are they? What are they? What are their goals? Okay,
so the Fed refers to the Federal Reserve, and this is a board of governors that has their main goal is to make sure inflation doesn't get too high. Okay, so they have a target rate of 2%. And you hear the term interest rate, right? The Fed's rate. Now, these aren't mortgage rates. These aren't treasury bill rates. This is the rate at which the Fed lends money to banks for them to lend out. So its biggest impact is on short-term financing like car loans, student loans, credit cards, home equity lines of credit. So that's the things that the Fed rates directly influence. It's really tied to the prime rate. So the prime rate is the Fed rate plus what the bank, a specific margin that the banks have. And sometimes banks put, a little bit on top of that for their rates.
So that rate isn't the rate that you see on the mortgages or anything, or
Correct.
credit cards or anything
Correct.
like that.
Yep.
So it's a little bit different.
It is a little bit different. It's the rate at which banks borrow money from the Fed.
Okay, gotcha. So with the Fed holding rates steady, does that mean that we've hit the peak of interest rates?
It's yet to be seen. And a lot of the conversation today from Federal Reserve Board Chair Jerome Powell was, there's the labor market's looking pretty decent. We have unemployment around 4.2%, and that's been steady. We've seen inflation drop significantly in the last, couple months or a couple of years, and we're down to just over their target of 2%. But there's an X factor out there. There's a lot going on with tariffs and things like that are just yet to be seen, and so they're kind of holding steady on their rates right now. They're not dropping their rates and they're not raising their rates.
Okay.
So to say that we've hit the peak high is again yet to be seen. Now it's widely accepted that tariffs might increase inflation. That would cause problems. So right now the Fed feels like they're in a decent place to kind of wait and see.
So they're kind of in a holding pattern to see what kind of happens with outside external kind of factors as well.
Correct. And I do believe, we've seen the price of oil come down significantly. It's at the lowest it's been since January of 2021. We've had the lowest oil price. Now, oil isn't, involved in every single good and service made, whether you're delivering it, going to work, whatever it is. I have to spend a certain amount of money on gas every month, right? So I don't have any added utility for gas costing more. And what it does, it takes away my ability to spend money on other things, right? So gas is coming down, and it should bring down and has brought down the cost of goods and services all over the place. But we still have the X factor of tariffs and knowing what added cost might be on goods out there coming into this country.
Gotcha. So what economic indicators or let's say data would need to shift before, we start seeing a meaningful change in the mortgage industry rates?
Well, that's really tough to say because all the data suggests that they should lower the rates right now. The problem is the Fed, for one time, is being speculative, and they're saying, well, because of the tariffs, we're concerned that the inflation might go up. Typically they say, well, we look at the data, but the X factor right now is the tariffs. So the data's in a good place. We had a negative GDP number last quarter, and negative GDP means the economy is shrinking. Now there's arguments that say that it will adjust upwards and it'll be more like 2 to 3% GDP number, but right now it has a negative number. And the employment, there's some mixed employment data, but they're going to look at the inflation data first and foremost. They're going to look at labor data and the cost of labor. If the cost of labor keeps going up and up and up, that's going to cause more inflation because, if you have to pay someone more, you have to charge more to pay them. To stay profitable as a company.
Yeah. And there's another layer that we talk about daily, and here is the bond traders and how they react to the data. Can you talk about a little bit behind what the bond traders are thinking and how they react to the data? Because it's sometimes we think that something's going to happen when the data comes out, but the opposite happens.
Yeah, not to get too technical for this one, but the bond traders are looking at the data also, and they're going to try to get ahead of the Fed, because if the Fed says we're dropping the rates today, it would have been a big surprise. I mean, most people thought that the Fed was going to keep the rate the same. So that was baked into the market. Now, had they dropped the rate today, it would have caused turmoil in the markets. The Fed said, look, we're surprising everyone with a 25 to 50 basis point cut on the rates. It would have sent the markets into a turmoil because it wasn't expected. Anything out of expectations are going to move markets. But today they did was as expected. Now, the bond traders like to get ahead of that because, they'd rather buy cheaper and sell higher than the other way around. But they looked at the same thing. There wasn't a huge impact to those bond markets today. We already had a positive. There's a bond auction yesterday, a T-bill auction yesterday that went very well, and it helped lower interest rates just a little teeny tiny bit. But we've been on a good track the last couple of days with the rates coming down just a little bit.
Yeah. And so, how does the Fed's continued reduction in mortgage-backed securities, MBS, impact rate trends?
Well, you're talking about quantitative tightening. Okay, so the Fed has a couple tools. Number one tool they use is their interest rate, the rate at which they lend banks money. Okay, so that's their first tool. And as we saw in COVID in 2020, they dropped the rates to zero.
Yep.
Well, that's not their only tool. They said, okay, well, we have the ability to buy mortgage-backed securities, or as you called them, MBS, mortgage-backed securities, and 10-year Treasury notes, also known as the T-bill. So when you buy these bonds, and when you buy something, if everyone wants to buy something, there's competition for purchasing, it typically raises the price of that good or service. And this is a bond. So because you raised the price, you lowered the effective yield or the interest rate. So, not to get, again, too technical here, because I can go on for hours about this stuff, but, that's a tool they have to push liquidity into the marketplace. More money in the marketplace, the more dollars people have in their hands, the more they can go and spend. So if the economy's hurting and you want to improve your economy, you give the people more money. How you do it? You throw a lot of liquidity out. You give them cheap money. They can borrow at inexpensive rates. If the rates are zero to borrow money, you're not going to think twice about borrowing money. If the rate's 10% to borrow money, you're going to really think about borrowing money. And so if you have to borrow money, the more money that's borrowed, the more things that get bought, whether it's property, machinery, it doesn't matter. If you want to put something on your credit card and your credit card rate's 10%, that's one thing. But if it's 27%, that's another thing altogether.
Yeah.
So by lowering the rates, you're effectively putting more money or more potential money into the hands of consumers to buy more things, which helps prop up an economy. Did I answer your question? I can't even remember now.
Yeah. Okay. What was the question?
What was the question again?
No, you definitely did. So that kind of brings us to a next point is, there's a lot of buyers who are waiting on the sidelines for rates, to drop, whether they will or won't, and when is, you need a magic, 8-ball.
8-ball, right. I have one somewhere.
So what would you say to those prospective clients, and should they act now or should they wait?
Well, okay. So obviously we've gotten this question a ton. Should I buy now, or should I wait for the rates to get lowered, right? And so, first of all, do you need a place to live?
Always.
Okay. And is in rent, how much of your rent goes to savings?
Zero.
Okay. So what's the effective interest rate of rent?
Zero.
It's 100%.
Oh, yeah.
100% of your money goes away. At least when you buy a house and part of your payment goes into the principal of the property.
Yep.
So you're saving money. Now, if you plan on moving in a couple of years, buying doesn't make sense whether your rates are 1% or 10%, right? But if you plan on being in the same place, you need a place to live, and you don't want to throw away money, it might make a lot of sense to look at buying now. Now, when the rates do go down, assuming they go down, right? Don't know if that's going to happen or not, but assuming rates go down and you are waiting on the sidelines, it stands to reason there's other people waiting on the sidelines as well, right? So when all those people run in to buy something, like I said earlier, the more people out to buy a good or service, the more the prices will rise. So the question is, do you want to buy at today's prices and then have the ability to refinance when the rates go down, or do you want to be subject to higher prices at a later date? That's really the question you got to answer for yourself. So obviously, I'm a little biased because I am in the mortgage business, and we do sell mortgages and we sell money. But the reality is that right now, the seller might be a little bit more willing to negotiate with you. They might be a little bit more willing to pay closing costs. They might be a little bit more willing to have more favorable terms for you. But if everyone's trying to buy at the same time, we might have a 20 or 21 situation again, 2021 and 2020 situation again, where there's more buyers than sellers. And that caused the market to shoot up for people to pay more for property. And I do think that the situation right now is that there's a little bit more favorable to the buyer than the seller.
Yeah, absolutely. It's a great time to get a good deal on houses for sure. And so that's kind of what we talk about as well. We see that, when rates go down, obviously there's a lot of people that rush to buy homes, and homes are one of the biggest buckets in inflation that they're looking at.
Right.
So when Jerome Powell's, making these decisions, you don't want to lower rates too quickly and then have inflation shoot back up.
Correct. Yeah, but there's there's a lot of give and take in this, because by the same accord, if you have interest rates higher, which right now you alluded to the selling and buying of mortgage-backed securities. Well, there's a thing called quantitative tightening. This is the other tool. So the number one tool is that rate. The second tool is their ability to buy or sell mortgage-backed securities or T-bills, which we talked about. And in the last meeting, they announced the easing of quantitative tightening, not quantitative easing, but they pulling back on quantitative tightening, but only for the T-bills. So they were selling $25 billion, that's billion with a B. $1 billion. They were selling $25 billion worth of treasury bills monthly. They reduced that down to $5 billion. They were selling $35 billion of mortgage-backed securities monthly. They're still selling $35 billion. So they're keeping the rates artificially high. So any new entrants to the market are going to pay, what they're paying right now for rates. So that's going to keep housing costs artificially high in the short term. Now, do I think that's artificial? Really, the rates are, not terrible. Depending on where you're at, 5, 6s, 7s, depending on what your situation is. Historically speaking, it's not bad. Now, that's tough to tell someone who had an interest rate at 2.5% a couple of years back.
Yeah.
So I understand it's definitely more expensive than it was.
Yeah. So last question, how can real estate professionals help clients navigate in this in-between market that we're kind of in right now?
It's education, right? It's education. The first thing is educate your clients. And, if you don't, and it's okay, if you're a specialist in real estate, you might not know the mortgage side of it. Get them to a mortgage loan originator who is good and trusted that can help them understand their costs. And if the client's good with the costs, it doesn't matter what the interest rate is. Yes, we all want to pay less for money. I get it. But at the same time, we need a place to live and we don't want to throw money away and we want to get a decent deal. And we have a decent opportunity for that now. And in the future, I can't promise that's going to look the same. And so with what can a real estate professional do? Number one, educate. And if you need help educating, reach out to a mortgage loan originator that can help educate them on these things, help them find the right loan for their specific situation, not what the lender wants to sell them, but their specific situation, and educate the client on the needs. That's what we do here at Morgan Financial. And so if you need a mortgage loan originator that can help you out, we have a contact form below, but that's really what we specialize is in helping the client get the loan that's best for their needs, not ours, theirs.
We also do refinances. So
we do refinances.
Yeah,
People give me a hard time for saying refinance.
You sound more proper.
I think so. I'm not British, but I might maybe a little hint of it in there. But
cool. Good stuff.
Good. Well, look, if you got any value out of this, please do me one solitary favor and hit the like button down below. If you're not a subscriber to our show, hit the subscribe button. It will give you notifications in real time when we have new shows out. Nate, thanks for joining us today. I really appreciate it. And with that, see you next time.